Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at how central banks can use their deep pockets to move the value of a currency for their country's economic benefit. In today's lesson we're going to continue our discussion on the participants in the foreign exchange market with a look at the rest of the participants in the market and how they affect us as individual traders. So let's get started.
Behind central banks in terms of size and ability to move the foreign exchange market are the banks which we learned about in our previous lessons which make up the interbank market. It is important to understand here that in addition to executing trades on behalf of their clients, the bank's traders oftentimes will try and earn additional profits by taking speculative positions in the market as well. While most of the other players we're going to discuss in this lesson do not have the size and clout to move the market in their favor, many of these bank traders are an exception to this rule and can leverage their huge buying power and inside knowledge of client order flow to move the market in their favor. This is why you hear about quick market jumps in the foreign exchange market being attributed to the clearing out of stops in the market or the protection of an option level, things which we will learn more about in later lessons. The next level of participants are the large hedge funds who trade in the foreign exchange market for speculative purposes to try and generate alpha or a return for their investors that is over and above the average market return. Most Forex hedge funds are trend following, meaning that they tend to build into longer term positions over time and profit from a longer term uptrend or downtrend in the market. These funds are one of the reasons that currencies oftentimes develop nice longer-term trends, something that can be of benefit to the individual position trader. Although not the typical way that hedge funds profit from the market, probably the most famous example of a hedge fund trading foreign exchange is the example of George Soros' Quantum Fund, who made a very large amount of money betting against the Bank of England. In short, the Bank of England had tried to fix the exchange rate of the British pound at a particular level by buying British pounds, even though market forces were trying to push the value of the pound down. Soros felt that this was a losing battle and essentially bet the entire value of his $1 billion hedge fund that the value of the pound would decrease. The market forces which were already at play, combined with Soros' huge position against the Bank of England, caused so much selling pressure on the pound that the Bank of England had to give up trying to prop up the currency, which proceeded to fall over 5% in one day. This is a gigantic move for a major currency, and a move which netted Soros' Quantum Fund over $1 billion in profits in one day. Next in line are multinational corporations who are forced to be participants in the Forex market because of their overseas earnings, which are oftentimes converted back into US dollars or other currencies depending on where the company is headquartered. As the value of the currency in which the overseas revenue was earned can rise or fall before that conversion, the company is exposed to potential losses and or gains in revenue which have nothing to do with their business. To remove this exchange rate uncertainty, many multinational corporations will hedge this risk by taking positions in the Forex market which negate any exchange rate fluctuations on their overseas revenues. Secondly, these corporations also buy other corporations or other overseas corporations, something which is known as cross-border mergers and acquisitions. As the transaction for the company being bought or sold is done in that company's home country and currency, this can drive the value of the currency up as demand is created for the currency to buy the company, or down as supply is created when the company is sold. Lastly are individuals such as you and I who participate in the Forex market in three main areas. The first is as investors seeking yield. Although not very popular in the United States, overseas, and particularly in Japan where interest rates have been close to zero for many years, individuals will buy the currencies or other assets of a country with a higher interest rate in order to try and earn a higher rate of return on their money. This is also referred to as a carry trade, something which we will learn more about in later lessons. The second reason is as travelers. Obviously, when traveling to a country which has a different currency, individual travelers must exchange their home currency for the currency of the country where they are traveling. Lastly is as individual speculators who actively trade currencies trying to profit from the fluctuation of one currency against another. This is, as we discussed in our last lesson, a relatively new phenomenon, but most likely the reason why you are watching this video and therefore a growing one. That's our lesson for today. In tomorrow's lesson, we're going to look at the main cities and time zone where the majority of Forex trades flow through and the differing characteristics of the 24-hour trading day. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.